Okay, so imagine you just hit buy on a stock, maybe a bond. Most of us, we picture that moment, the trade happening. But what actually happens after that click? The truth is, well, that's really just the tip of a very complex iceberg. Beneath the surface of the financial markets, there's this whole hidden labyrinth. Some people call it the financial market plumbing. We're talking clearing, settlement, reconciliation, custody, meticulous record keeping. It's quite an intricate dance. And it involves a whole cast of characters: custodians looking after assets, central counterparties managing risk, central securities depositories making sure ownership is properly recorded. But here's the thing, right? Despite all the tech advances over the decades, the system is still remarkably, well, slow and costly and fragmented. Trades often take 2 full business days to actually settle. That's what the industry calls T+2. And because you've got so many different parties, different systems, there are just countless manual checks along the way, which, as you can imagine, introduces risk, adds delays, and, frankly, a lot of inefficiency into the whole system.
But what if we could completely rewrite the rules for this entire landscape? What if we could streamline every step, make it dramatically faster, maybe infinitely more transparent? That's the really electrifying possibility that is being brought to us now by digital assets and the magic of tokenization, all powered by blockchain and distributed ledger technology.
It really is a profound rethinking of how value moves. I mean, fundamentally, when we talk about digital assets, we mean any asset that exists purely in a digitized format. Its ownership, its transfer, it's all recorded and stored using digital tech, usually blockchain. Tokenization then takes this a powerful step further. It's the process of converting the rights to a real-world asset. Think equities, bonds, maybe real estate, even fine art, into a digital token that lives on a blockchain.
Yeah, and to really get the difference, think about a traditional bond issuance. It's like a multi-act play, isn't it? You have the issuer, the underwriters, multiple custodians, different clearing systems, central depositories. Each one has its own records, its own reconciliation process, transferring ownership, making interest payments. It's all these separate steps across many different entities. Now picture that same bond, but tokenized. It's represented by a digital token on a blockchain. Ownership transfers, coupon payments, even the principal repayment, all that could potentially be programmed directly into a smart contract. And these contracts execute automatically, transparently, when the conditions are met.
So no more redundant data entry across different systems, no more painstaking manual reconciliation. It's just a fundamental shift in efficiency.
Right. And that's where the benefits really start to become clear, doesn't it? We're potentially moving towards incredibly fast settlement, maybe even real-time, T+0. Just think about what that means for liquidity in the market. And it's not just about speed, it's also about transparency, an unprecedented level of it. Every single transaction on a shared ledger is timestamped, it's verifiable, easily auditable almost at a glance. But what I find particularly intriguing is this idea of fractional ownership, breaking down high value, often illiquid assets, things like commercial buildings or famous art, into smaller tradable units. Tokenization isn't just an efficiency play then. It actually democratizes access to investments that were previously just for the big institutional players. Imagine owning like a tiny piece of a skyscraper or a fraction of a Monet. That's a huge step for financial inclusion.
That's exactly right. And it's important to remember, not all digital assets are the same. Broadly, we can kind of put them into 3 buckets. First, you've got your native cryptocurrencies, like Bitcoin, which aren't actually tied to any real-world asset. Then there are stablecoins. These are digital tokens designed to maintain a stable value, often pegged to something like the US dollar. But for our conversation today, our main focus is really squarely on these tokenized assets, these digital representations of traditional financial instruments. They're the ones driving the most significant innovation in how post-trade operations are actually functioning.
Okay, so the promise here is obviously immense. Huge potential. But like with any really transformative technology, this isn't just about the cool tech, is it? This shift raises some pretty profound questions about the future roles of traditional financial institutions, the incumbents. And it also brings in entirely new layers of legal, operational, and regulatory complexity that, frankly, the industry is only just beginning to figure out.
Exactly. So for the rest of our discussion, let's maybe dig into how this technology is reconfiguring those existing post-transaction processes. What are the specific hurdles it's creating? And importantly, what does understanding these changes mean for you, whether you're, actively navigating the financial markets or perhaps just curious about where they're heading? It's a really crucial evolution. It's going to reshape how value is exchanged globally.
It really is fascinating when you think about how tokenization fundamentally changes what happens after the trade. In the, let's call it the traditional world, once a trade executes, it kicks off this long chain of sequential steps, right? confirmation, matching, clearing, often through a central counterparty, a CCP, and then finally, settlement via essential securities depository, where the ownership actually changes hands. Each step relies on separate systems, distinct legal frameworks, and crucially, it introduces time delays and costs. It's, well, the legacy system with friction built right in. But with tokenized financial instruments, particularly those built on DLT, the approach is just fundamentally different. The core idea, as I understand it, is that critical functions like clearing, settlement, even parts of custody can be embedded directly into the blockchain's architecture itself. So this means that once a tokenized trade executes, the transfer of ownership and value can happen almost instantly, often removing those traditional delays and, importantly, the need for multiple layers of reconciliation between different parties.
hmm And this has massive implications, really, across all facets of post-trade activity. Take clearing and counterparty risk, for instance. Traditionally, you have CCPs, central counterparties, stepping in to manage that risk. They essentially guarantee the trade on both sides. With smart contracts and DLT, settlement can happen on what's called a delivery versus payment or atomic basis. This means both sides of the trade, the asset and the payment, they move at the exact same moment, simultaneously. There's no time gap where one party could potentially default. That significantly reduces counterparty risk. However, this atomic settlement, while efficient, it does raise new questions. Questions about liquidity management, especially intraday liquidity, and also about the netting benefits that CCPs have historically provided across huge numbers of trades. So there's a trade-off there.
That makes perfect sense. It's a different model. And the impact on settlement timing and efficiency must be huge. As we said, most markets are on T+2 now, 2 business days. That lag time exists, well, to coordinate instructions, secure funding, fix any problems. With tokenized assets, real-time, T+0 settlement is actually achievable, or maybe even flexible programmable settlement schedules. Now, while this dramatically cuts settlement risk, it also puts immense pressure on market participants, doesn't it? They need to have liquidity available instantly. That could fundamentally disrupt traditional funding strategies that are built around that 2-day buffer. It's a big shift from batch processing to real-time demands.
Absolutely. And another critical area being reshaped is custody and safekeeping, holding the assets. Custodians have always been central players, holding and protecting securities for investors, managing things like dividends or stock splits, corporate actions. But with blockchain, ownership of tokenized assets is often maintained directly by the investor through digital wallets. And transfers are validated by the network itself, not necessarily a central intermediary in the same way. Now, while this idea of direct ownership is appealing to some, it definitely introduces entirely new challenges. Challenges around security, the crucial management of those private cryptographic keys, and fraud prevention. It's a different security model. And this paradigm shift has led to the emergence of digital custodians, a whole new category of service providers. They're trying to blend traditional custody practices with cutting-edge digital asset infrastructure to securely manage these keys and the associated risks.
Right. It sounds like a whole new skill set needed for custodians. And I guess reconciliation and record keeping must be dramatically simplified then. That's often a big headache.
Oh, absolutely. Reconciliation has historically been one of the most burdensome parts of post-trade, just constantly having to align records across trading platforms, clearinghouses, custodians, regulators. It's a massive task. In a DLT environment, the idea is you have a single shared ledger acting as the authoritative source of truth for everyone involved. This fundamentally reduces the need for that constant, repetitive reconciliation. And it allows for things like real-time auditing and compliance checks. The key, however, is establishing universal access to and trust in that shared ledger, which, as you can probably imagine, is not a simple thing to achieve in today's fragmented financial world. It requires coordination and standards.
Okay, so if this technology holds so much promise, faster, cheaper, more transparent, what are the really tough challenges? What are the hurdles financial markets are grappling with right now? I imagine custody, as you just mentioned, has got to be front and center.
It truly is. Redefining custody in this digital environment is probably one of the most complex puzzles. In traditional markets, custodians are trusted intermediaries. Their role is legally well-defined, heavily regulated. They safeguard assets. But with digital assets, ownership really hinges on possessing private cryptographic keys. If you lose your keys, the asset could be gone, irretrievable, maybe forever. And if they're stolen, the assets can be transferred instantly, irreversibly. So digital custodians need a completely different skill set. They need supreme digital key management, bulletproof cyber risk controls, seamless integration with blockchain networks. It's just a very different risk profile and a significant operational undertaking. And then beyond custody, we've faced really significant legal and regulatory ambiguities. That's a huge one. There's just a fundamental lack of harmonized legal recognition for tokenized assets globally. It's a patchwork. Current securities law, well, it was written long before blockchain was even conceived. It doesn't explicitly define digital tokens as securities in all cases or clarify what constitutes legal possession. This leads to really crucial questions for investors, right? Can digital custodians be held liable in the same way as traditional ones? Is holding a private key truly the same as legal ownership everywhere? How are basic investor protections upheld in these sometimes decentralized environments? And until regulators provide clearer, more consistent frameworks, many institutional investors, quite understandably, are hesitant. They see too much legal and operational risk.
And what about the operational side? Just the nitty-gritty of making this work day to day. How does integrating this new tech impact that?
Yeah, operationally, integration is a massive hurdle. The global financial system is incredibly interconnected, but most institutions still run on this patchwork of legacy infrastructure. Some of it is decades old. Trying to integrate new blockchain-based solutions with these older systems, it requires real interoperability, and that's a significant technical and governance challenge. Without standardized protocols, you risk creating fragmented settlement environments. Different blockchain platforms operating in silos, unable to talk to each other effectively. Building those bridges, those pathways for information and value to flow smoothly between old and new systems, that's absolutely essential before digital custody and settlement can really scale up within the broader financial world. And this leads directly to another major challenge: regulatory divergence. The global landscape for digital assets is incredibly fragmented. Unlike traditional finance, where rules are largely harmonized through international bodies, digital asset regulations are just evolving in vastly different ways across different countries. In the United States, for example, the regulatory environment is, well, fragmented across multiple agencies. The SEC often takes an enforcement-first approach to deciding what constitutes a security. This creates a lot of compliance risk and uncertainty for firms. Now, in stark contrast, you look at the European Union. They've adopted a more structured framework with MiCA the markets and crypto assets regulation that provides a pretty comprehensive rulebook. They also have a DLT pilot regime specifically designed to test how traditional functions like trading and settlement can operate on blockchain under temporary exemptions. So more of a sandbox approach. Meanwhile, places like Singapore and Hong Kong are actively encouraging innovation through their own sandboxes and clearer licensing regimes. And then other regions like South Africa might have a more cautious but evolving stance, maybe exploring central bank digital currencies, but often regulating digital asset clearing and settlement within existing frameworks that might not be a perfect fit. This whole patchwork of rules just massively complicates cross-border activities for financial institutions. It makes them hesitant to fully embrace tokenized assets. I mean, imagine trying to settle a global bond if the legal definition of its token changes every time it crosses a border. It's basically a non-starter for large-scale adoption right now.
Wow, yeah, that regulatory patchwork sounds like a nightmare to navigate. So it sounds like smart contracts could be a huge part of the solution here, potentially automating a lot of that complex clearing and settlement process.
Absolutely. Smart contracts are essentially self-executing agreements. They're just lines of code, really, but they automatically enforce and execute the terms of a contract once certain predefined conditions are met. So this means they can verify if both parties have fulfilled their obligations, for instance, providing the necessary collateral or cash before instantly triggering the transfer of the tokenized assets and the payment. This level of automation can dramatically reduce errors, eliminate delays, and lower operational costs by removing the need for humans to manually check and reconcile data. And it also enhances transparency because every action is recorded and auditable in real time on that shared ledger.
It sounds incredibly efficient on paper, but I'm guessing there are challenges with relying solely on code for something so complex and high stakes.
There certainly are. I mean, encoding every possible scenario, every exception, every regulatory requirement into smart contract code for complex financial instruments, that's a massive technical challenge. Even minor coding errors, bugs, can lead to significant, potentially irreversible financial losses. Legal enforceability is also a critical concern. How do you translate nuanced aspects of contract law, like dispute resolution mechanisms, into immutable code? It's not always straightforward. And smart contracts often need external data feeds, they're called oracles, to interact with real-world information, like current asset prices or interest rates. These oracles themselves represent potential points of failure if they aren't perfectly designed, secured, and kept independent and reliable. So, yes, challenges remain.
Okay, so as we sort of wrap up our exploration today, it's really clear that this shift in post-trade operations, driven by digital assets and tokenization, is truly profound.
It promises to streamline workflows, embedding clearing and settlement functions directly into blockchain networks. That reduces reliance on many traditional intermediaries and enables potentially near instantaneous transfers. And smart contracts look poised to add incredible programmability and automation, improving accuracy and transparency across the whole system.
Indeed. But as we've discussed, financial markets are definitely navigating several critical challenges right now. Custody is being fundamentally redefined, moving from physical certificates or book entries to securely managing cryptographic keys. That's given rise to these new digital custodians. But it also brings inherent risks like key loss or theft, demanding a whole new level of security expertise. Then there are those persistent legal and regulatory ambiguities, especially the lack of harmonized global rules for tokenized assets, which makes fundamental questions about ownership and investor protection really complicated across borders. And while atomic settlement is super efficient, it does eliminate those traditional buffers for liquidity management and reconciliation, forcing participants to rethink their funding models entirely. Operationally, integrating these new blockchain solutions with existing legacy infrastructure is still a significant hurdle. Without widely adopted, standardized protocols, there's a real risk of creating more silos, more fragmented environments. And of course, that regulatory divergence, we talked about the US approach versus the EU's MiCA versus the sandboxes in Asia versus cautious approaches elsewhere, that patchwork massively complicates cross-border activities and understandably makes traditional institutions wary about diving in headfirst.
Right. It seems clear that smart contracts are definitely going to be an integral part of this future landscape, but perhaps more likely in hybrid solutions, where automation handles the routine tasks, but human oversight and judgment remain crucial for those complex, nuanced decisions.
Precisely. Addressing these sweeping changes really requires broad collaboration. We need regulators, market infrastructures, financial institutions, tech providers, legal experts, everyone working together. We need to develop interoperable standards, robust governance frameworks, and truly resilient systems that can handle this new world. And pilot programs, regulatory sandboxes, they're vital tools in striking that delicate balance between fostering innovation and managing systemic risk effectively.
What's so exciting, though, is the immense potential that goes beyond just efficiency gains. This transformation isn't just about making things faster or cheaper. It really could democratize market access. It could foster financial inclusion on a truly global scale and ultimately create a more transparent, more resilient, and more accessible financial ecosystem for everyone.
Which really raises the important final question for all of us to think about. As these digital shifts fundamentally reshape the very architecture of global finance, what new forms of trust and security will we actually need to build? And how will these changes fundamentally alter our relationship with value and ownership itself?